Okay.
Let it on.
Hi, a very good evening to my respected lecturer and my fellow friends. Today we would like to do a small presentation regarding corporate finance. So before that, I would like to introduce the group members. First, Mogan Raj B. Ashokan, Karishma Vartini Maniarasu, Senthen Subramaniam, myself, Rajeshwar Shanmugam, Kalayarasu Vijay Kumar, and John Anthony. So this is
Okay,
the table
next.
of content for our slide. So we can see here we have segregated into two. Section A, there's 4 questions, and for section B, there's 3 questions. So as for section A, this is about the analyze the performance for the company A and company B. So here we can see that this analyze have been segregated into 5: liquidity, profitability, solvency, efficiency, and earning and valuation. For the liquidity, we can see that for company A and company B, the current ratio is 1.878, and for the company B is 1.581. As for here, we can see the company A demonstrates healthier liquidity compared to B. Quick ratio is abnormally high. As for profitability, the growth for both sides, we can see A leads significantly in the migraine performance. As for solvency, we can see that B has lower debt, but A managed debt more sustainability. As here, we can see for efficiency, company B leads in fixed asset, use Excel elsewhere. And for earning and valuation, A delivers positive returns and B shows losses. So here, as for conclusion, we can identify for company A, constantly outperforms company B in liquidity, profitability, solvency, and overall financial strength, despite isolated operational strength shown by B. Now I'll pass the slide to Karishma.
For the second part, it is about compare the performance of company A over the 3 years. A stable financial position has been maintained by company A. Its liquidity is well maintained with the current ratio remaining steady and quick ratio improving from year 1, which is 0.798 to year 3, 0.982, which reflects better management of liquid assets and inventories. This specifies that the firm is becoming more efficient of meeting its short-term commitment without relying on stock clearance. Then, in terms of profitability, which is the profit, there is a slight decrease in the net profit margin, which is from 9.1% to 6.6%. This translates to a drop of 2.5 percentage points, recommends increasing operational or input costs that are eating into its gains. For example, if the company had RM 100 million in profit, its net profit would have dropped from RM 9.1 million to RM 6.6 million over the period, which is RM 2.5 million decrease. The firm's credit worthiness perspective is company A has become more effective in applying its funds. The account receivable turnover ratio increased from 6.8 to year 3, 8.898, where the company collects receivable even faster. And the collection period reduced from 53.7 days, which is 365 days, divided by 6.8, which is to 41 days. This indicates tighter credit control. Moreover, strong inventory turnover recommends efficient stock management. However, the returns to the shareholder have barely reduced, with incomes per share dropping from year 1, 15.15 cent to 11.8 cent. Company A, as a summary, stays financially sound with improvement in cash availability, financial stability, and productivity. However, it faces average profitability pressure, which may affect future earning if cost control is not enhanced. Next, I would like to pass the slide to John.
I am John here, and I'm going to explain question 3, which is about compare the performance of the company B over 3 years. Company B performance has significantly dropped over past 3 years. In the term of the liquidity, the current ratio of the company performance is dropped from 32.138 to 1.581. Profitability also dropped significantly, which is the net profit to the company fell from the 9.1% to negative 0.3%. This reflecting that the company is operation at loss. In the perspective of solvency, the company has frequently maintained a low debt to equity ratio, which is the frequently 0.1%. The asset turnover ratio of the company B is developing slightly, but it is still low on the under 20 to under 80 days, which is indicated the improvement is slow and FHD level is still below industrial standard. The company B dropped sharply, which is the 38.26 cent to 0.85 cent in earning per share. This drop is EPS is reflect the company quickly need a strategy development in the revenue generation and the cost management. Company B performance fall sharply in the past 3 years. That's all from me and pass to Karishma.
For the fourth one, clarification of the ratios. The first ratio is liquidity ratio, where it measures a company's capability to meet its short-term financial duty. For example, paying off current liabilities using current assets. Then, profitability ratios. This shows how effectively a company manages expenses and delivers returns from its activity. Other than that, solvency ratios. This assess a company's long-term financial health by analyzing its reliance on borrowed funds. After that, turnover ratios. This measures how efficiently a firm handles its assets such as receivable and inventory to support operations. Then earnings per share and price to earnings ratio. This ratio shows shareholder return and the level of market trust in the firm's future opportunities. Next. Company A shows a strong financial base with managed financial risk, and there has been a minor decrease in the net profit, which is 9.1% to 6.6%. This may happen due to inflation. The company has displayed strong operational performance as a proof of enhanced receivable turnover, which is 6.8 to 8.898, and efficient inventory management. Those developments reduce cash flow setback and helps to maintain the working capital efficiency. In the term of solvency, Company A reduced its financial liability with a debt to equity ratio advancement from 1.659 to 1.157. This shows better debt management and less financial risk. Although the EPS has declined a little, which is 15.15 cent to 11.8 cent, this reflects a positive return from its shareholder. In overall, Company A is managing everything more consistent and long-term growth. Next.
Okay, so next we will be going to section B, where I will pass the slide to Pradeep.
It's not Pradeep. I am Kalayarasu.
Okay.
The first question is section B, referring to why is non-financial information is important for evaluating a company. Okay, so basically non-financial information is fundamental to evaluate a company. Since both Malaysian companies, which known as a Company A and Company B, are involved in highly resource-intensive industries like metal manufacture and constructions. Okay. Firstly, non-financial information such as industry focus, target market, and product specialization very helpful to stakeholders and investors to impact of an intentional assess company standing. For example, Company A mainly supplies aluminium, extraction, smelling products, and Company B focus on steel pipes and hollow section. Estimate growth potential based on booms, slums, and infrastructure and developments. Secondly, is help highlights how resilient companies are to international market volatility or political shifts. For example, since both company A and company B are engaging in exports to so-called export-oriented operations, knowing geography rich dependence on international trade, exposure, or foreign rules and tariff is must be obtained. Therefore, profit are impacted by exchange rate fluctuation in exchange rates, such as Malaysia ringgit and US dollar. Awareness of environmental, social governance, so-called ESG guidelines are becoming essential for long-term sustainability, investor trust, and regulatory compliance. Company A publish sustainability reports and as a more well-established ESG frameworks. However, company B remains line remains in line with ESG practice which high maturity but room for development. ESG headgears lowers the risk of regulation like carbon leaves, builds stakeholders trust and improve brand image. Both companies, Company A and Company B, must adhere to regulatory reporting and governance standards as they are publicly listed on Bursa Malaysia. This non-financial information also plays an important role in evaluating a company as this strong governance guaranteed ethical behavior, strategic focus, and responsible decision making. Last but not least, non-financial information on client relationship, contract duration, and industry standing are playing an important part in evaluating a company consistency in revenues, risk to credits, and dispute resolutions. Here, company A and company B, both primary businesses model are business to business, B2B, supplying to other business such as developers, manufacturers, and construction firms. Financial ratio let us know what happened, profitability, efficiency, and etc. But non-financial data disclose us why it happened and how long-lasting the effects are. For an extensive and proactive assessment, non-financial information pertaining to ESG, positioning in market, governance, and industry trends are very important for capital-intensive, resource-heavy business like Company A and Company B. That's all from me. I pass to Mr. Rajeswaran. Thank you.
Okay.
Okay, sorry, give me a second. Okay, thank you to Mr. Kale. From here, I will brief compare how corporate governance support sustainability in two Malaysian manufacturing firm, Press Metal and Chubi. Malaysia's MCCG 2021 makes it clear boards must treat ESG in separately from financial responsibility. Both firms being listed on Burma Malaysia are required to embed ESG in governance. Press Metal with a RM 40 billion market cap applicant a multi-layered governance model. It has dedicated committee, a sustainability roadmap and link ESG KPIs to executive pay. The company actively manage climate and safety risk, edge price volatility, and invest in hydropower and upstream integration to boost resiliency and reduce emission. It integrated report whilst blowing mechanism and independent board compensation reflect transparency and strong ethic culture. In contrast, Chubi is a smaller steel pipe manufacturer with leaner governance. The CEO also chairs the board, but governance is evolving. The Sustainability Working Group use of GRI and TCFD and stronger environmental performance like significant emission cuts shows real commitment. Even without large resource, Chupi trades short-term gain for long-term ESG strength. In summary, while while press method shows how large firm can rigorously embed ESG through structure governance, Chupi proof that smaller firm through leadership and focus can also make meaningful strike. Governance ultimately ensure both firms stay competitive, resilient, and aligned with rising ESG expectation. Okay, next slide. Okay, I'm going to explain about impact of employee welfare and human capital on operation performance. How employee welfare and human capital directly influence operational performance at two Malaysian manufacturing firms for Press Metal and Chubi. At Press Metal, a large-scale aluminum producer, the company views welfare as a strategy asset. Its standout initial, a complete township in Samalaju, helps lower turnover, improve morally, and enhance operational continuity. Safety and internal training are regularly enforced, contributing to cost control and innovation. Their 2023 profit departure market challenge reflect the value of a loyal and skilled workforce. In contrast, Chubi, a smaller steel pipe manufacturer, focus on foundational welfare like safety instruction, fair pay, and a respectful family-like culture. True modest, their efforts are vital in a lean workforce where each worker's output matter ah insig insignificantly. Challenge like slower inventory turnover and a minor loss in 2023 suggests room for productivity gains through better training and moral initials. In a short, both firms shows that investing in people, whether through larger hours program or regular safety briefing, is not just ethical but essential. Human capital drives productivity, safety, innovation, and ultimately compassion at once. Thanks from myself. That's it from us. I pass it to Senthen again.
Okay, so I think
Yes.
this is our end. Thank you for the presentation, my group members. Yeah, that's all. Thank you.
Thank you. Thank you, Prof.
Thank
Thank
you.
you, thank
Thank
you.
you, thank you.
Thank you
Thank
so
you,
much.
everyone.